You found it. The perfect setup. Charts aligned. Indicators singing. Everything you learned says go. So you go. And you lose. Again. Not because you're wrong, because you're right at the wrong time. Right in the wrong context. Right with the wrong size. Right while everyone else is right too. This is the trader's paradox. The setups that look best often perform worst. The entries that feel perfect frequently fail. The patterns you have mastered become the patterns that drain your account. I've watched it happen thousands of times. Watch skilled traders with solid strategies slowly bleed capital, not from bad trades, from good trades executed poorly, from perfect setups entered imperfectly, from technical excellence meeting psychological disaster. Today we're dissecting why your best setups cost you money. Not the random ones, not the impulsive mistakes, the planned ones, the studied ones, the setups you trust most, because that trust is expensive, and most traders never calculate the real cost. Part 1. The illusion of pattern perfection. Every trader has a favorite setup, that one pattern that clicks, that makes sense, that you've studied until you can spot it instantly across 12 different time frames. Mine was the bull flag. Clean continuation pattern. Price rallies hard, consolidates tight, breaks higher. Textbook momentum trading. I had a 73% win rate on paper. Beautiful equity curve in my journal. I thought I'd found my edge. Then I tracked something different. Not win rate, not average winner versus average loser. I tracked total profit per pattern instance. Every single time my perfect setup appeared, what did my account actually do? The results crushed me. My 73% winner was barely profitable. Some months it was net negative. Not because the pattern failed, because I overtrained on it, saw it everywhere, took marginal examples, forced entries when conditions were close but not quite right. This is pattern addiction. Your brain gets so good at recognizing something that it starts hallucinating it. Starts seeing your setup in noise, in choppy markets, in structures that resemble your pattern but lack the underlying dynamics that make it work. The sharper your pattern recognition, the more dangerous this becomes, because you're not making mistakes, you're making precise errors, trading things that look exactly like your setup but function completely differently. Consider the ascending triangle, classic bullish continuation, higher lows, flat resistance, eventual breakout upward. Works beautifully in trending markets with strong momentum, but show me that same pattern in a range-bound market, or during distribution, or after an extended rally, and I'll show you a trap. The pattern looks identical. Your eyes see the same structure. Your checklist confirms every criteria. But the context changed, the market phase shifted, and your perfect setup just became a perfect way to buy the top. Context overwhelms pattern, always. Every single time. But we teach patterns first, study patterns obsessively, build entire trading systems around pattern recognition, then wonder why things that should work don't. Here's what nobody tells you. Patterns don't have edge. Market conditions have edge. Patterns are just visible expressions of underlying order flow, sentiment, and momentum dynamics. When those dynamics shift, the pattern becomes a shell. Looks the same, functions opposite. I've seen traders with pattern accuracy above 80% struggle to make money. Not because they're wrong about the pattern, because they're blind to everything the pattern exists within. They optimized for recognition and forgot about context. This creates a cruel irony. The better you get at spotting your setup, the more you'll trade it. The more you trade it, the more you'll take marginal examples. The more marginal examples you take, the worse your overall performance becomes. Your skill becomes your vulnerability. And here's the expensive part. You won't notice immediately, because you are still hitting your targets some of the time, still getting wins, still seeing your pattern work. The degradation happens slowly, a slightly lower win rate, slightly smaller average winners, slightly more break-even trades, death by 1,000 paper cuts. The best traders I know don't have more setups than struggling traders. They have fewer, much fewer. But they have crystalline clarity about when those setups work and when they don't. They can tell you not just what the pattern looks like, but what market conditions need to exist for that pattern to have genuine edge. They don't just see the triangle, they see the trend strength preceding it. The volume characteristics, the volatility regime, the correlation with sector movements, the time of day, the recent price action context. They see the entire ecosystem that makes the pattern relevant. When you understand this, you stop hunting for your setup. You start waiting for the market to set the table properly, and then you look for your setup. Completely different approach, completely different results. Part 2. The confidence trap. Confidence kills accounts. Not fear, not hesitation, confidence. Every major loss in my trading career came during periods of high confidence, when I felt certain, when things made sense, when I knew I was right. That certainty made me size up, made me hold through warnings, made me ignore evidence that contradicted my thesis. Your best setups generate the most confidence. By definition, they're the patterns you trust, the entries you've seen work repeatedly, the trades where you feel smart, prepared, ready. That feeling is expensive because markets don't care about your confidence. Markets punish certainty. The moment you feel sure is often the moment you're about to be very wrong in a very expensive way. There's a fascinating study in behavioral finance. Researchers found that traders perform worse after strings of winning trades. Not because they get sloppy, because they get confident. They increase position size. They give losses more room. They trust their analysis more than the market's feedback. The same thing happens with your best setups. Each win reinforces your belief in the pattern, makes you more willing to tolerate heat, more willing to add to losers, more willing to ignore when the trade isn't acting right. I once held a losing trade for 3 days because it was my absolute best setup. Perfect entry, perfect technical structure, every indicator aligned. I was so confident in the analysis that I ignored the simple fact that the market was telling me I was wrong. Price wasn't moving. Volume was dying. Other similar stocks were breaking down. Everything screamed exit. But I stayed because I was confident, because this was my setup, because I'd seen this exact structure work dozens of times before. Final loss was 4 times what my initial stop should have been. 4 times. Not because I was reckless, because I was confident. I trusted my pattern more than I trusted price action. I trusted my analysis more than I trusted reality. This is the confidence trap. Your best setups feel so right that you give them special treatment, wider stops, more time, additional chances. You bend your rules because this particular trade fits your proven pattern so perfectly, but the market doesn't know it's your best setup. The market doesn't care about your back-tested results. The market is just processing supply and demand in real time. And sometimes your perfect setup emerges right when supply overwhelms demand, right when the broader market decides to reverse, right when your pattern becomes irrelevant. Confidence also makes you blind to distribution. When smart money is exiting, they often create patterns that look bullish to retail traders. Perfect setups with perfect structure, because that's how you attract buyers while you're selling. Think about late-stage bull flags. Price consolidates after a strong move, volume dries up. Then price breaks higher. Classic continuation signal, except when institutions are using that breakout to distribute to eager buyers. The pattern looks identical, your confidence level is identical, but the underlying dynamic is opposite. The traders who survive aren't less confident. They're differently confident. They're confident in their process, not their predictions. Confident in their risk management, not their analysis. Confident they'll follow their rules, not that their setup will work. That's a critical distinction. Confidence in your setup makes you rigid. Confidence in your process makes you adaptable. One keeps you in bad trades, the other gets you out quickly. I rebuilt my entire approach around this principle. I'm confident I'll cut losses fast. Confident I'll follow my stops. Confident I'll adjust if the market changes. But I'm never confident about what price will do next. Never certain about how any individual trade will resolve. This feels uncomfortable at first. Trading without certainty feels wrong, feels weak, feels like you don't really know what you're doing. But that discomfort is actually edge. That uncertainty keeps you humble, keeps you listening to the market, keeps you from doing stupid things because you feel smart. The best trade of my career came from a setup I was uncertain about. Marginal structure, decent but not perfect. I sized down because I wasn't confident. Got in with a tight stop because I wasn't sure. Took profits earlier than usual because I didn't trust it to extend. Made less than I could have if I'd sized normally, but I made something, and I protected capital, and I followed process, and that matters more than any single winner. Your worst trades will come from your best setups when you're most confident. Write that down. Tattoo it somewhere. Make it your trading mantra. Because until you internalize this, you'll keep making expensive mistakes that feel like good decisions. Part 3. The timing delusion. You can be right about everything and still lose money. Right about direction, right about magnitude, right about the pattern, wrong about when. Timing is invisible in hindsight. We look at charts after moves complete and think the entry was obvious, the setup was clear. Anyone could have taken that trade, but we're looking at resolved uncertainty, looking at a path already traveled, looking at the winning lottery ticket after numbers are drawn. In real time, every perfect setup exists in fog. You don't know if the breakout happens now or after 3 more fake outs. Don't know if the pullback finds support here or 20% lower. Don't know if this consolidation lasts 2 days or 2 months. Your best setups create timing illusions. They look so ready, so primed, so about to move. That appearance makes you early, makes you enter before the actual catalyst, before institutional flow shifts, before the real move begins. Early is expensive, because your stop is active while you wait. Your capital is locked while you're patient. Your opportunity cost climbs while nothing happens. And if you're wrong about timing by enough, you'll either stop out before the real move or hold through so much pain that you exit right before things work. I tracked my entries for 6 months against optimal entries based on where moves actually started. On average, I was 4 to 6 hours early. Not days, not huge mistakes, just 4 to 6 hours premature, entering breakouts that pulled back once more, entering support that gave way to one more probe, entering momentum before the real expansion phase. 4 to 6 hours doesn't sound like much, but in that window, price often moved against me enough to trigger stops, or cause pain, or force decisions. That tiny timing gap cost me roughly 30% of my potential profits, not from being wrong, from being early. And here's the cruel part. I was early because my setups were good, because I could identify structures before they resolved, because my pattern recognition was sharp enough to spot opportunities as they formed rather than after they confirmed. My skill made me premature. My edge created timing problems. The better I got at seeing setups develop, the earlier I wanted in, the more I paid for that speed. This affects position management too. When you enter early, you experience more heat, more drawdown before profit, more moments where the trade looks wrong before it looks right. That heat makes you either exit prematurely or hold stubbornly through actual failures. The optimal entry is rarely the obvious entry. It's usually after the first fake out, after the flush that scares out weak hands, after the pause that makes the pattern look dead. The setup that looks best in real time often needs one more cycle of pain before it works. But waiting feels wrong, feels like you're going to miss it, feels like the move will leave without you. So you enter too soon, jump the gun. Try to front-run the real entry, and you pay for that impatience even when you're ultimately right. I've watched traders nail the direction on 15 consecutive trades and still lose money. How? Timing. They were early enough that normal volatility stopped them out. Or they were late enough that most of the move was gone. Or they were right on entry but wrong on exit timing. Or they held too long trying to squeeze every point. Direction is only one component. Timing is everything else. And timing is much harder than pattern recognition, much more influenced by randomness, much less controllable through study and preparation. The solution isn't trying to time perfectly. That's impossible. The solution is building systems that tolerate timing uncertainty, wider stops that survive normal noise. Scaling that lets you add when timing proves right. Position sizing that keeps early entries from killing you. Exit strategies that don't require perfect timing to be profitable. Your best setups demand better timing because they're more visible. More traders see them. More money crowds the entry. More algorithms target the same levels. That competition compresses the edge, makes timing more critical, makes small delays expensive. If you're trading patterns everyone recognizes, you need near-perfect timing to profit, because everyone else is trying to enter the same place. The more obvious your setup, the more timing precision matters. The edge isn't in seeing it. The edge is in timing it fractionally better than the crowd. This is why simple patterns often outperform complex ones. Not because they're more accurate, because they're less crowded, because fewer traders see them, because the timing window is less competitive. Your best setup is probably your most crowded setup, which means it demands timing precision you likely don't have. Part 4. The size problem. Position size determines outcomes more than entry quality. You can enter perfectly and lose if you're too big. You can enter poorly and win if you're properly sized. But we don't think about size that way. We think about getting the setup right, getting the entry right, getting the target right. Size feels like a separate decision, a checkbox, a math problem to solve after the real analysis is done. That's backward. Size is the analysis. Size is the trade. Size determines whether a good setup makes you money or destroys your account. Your best setups create size problems. They feel so right that you want to press, want to maximize, want to capture everything this perfect opportunity offers. That desire makes you oversize, makes you bet too much capital on a single trade, makes you vulnerable to normal variance in dangerous ways. I learned this through pain. One of my best patterns showed up during perfect market conditions. Everything aligned. I sized up to 3 times my normal risk. Trade went against me immediately. Nothing crazy, just normal initial heat. But at 3 times size, normal heat felt catastrophic. I cut it early. Booked a loss that was tolerable at 3 times size, but felt massive relative to my normal trades. Price then did exactly what I expected. My analysis was perfect. My sizing destroyed me. The psychological damage lasted weeks. I replayed that trade constantly. Knew I was right. Knew I gave up before the setup worked, but I also knew that at 3 times size, I couldn't tolerate the natural variance. The size itself created the failure. This is the size trap. Good setups make you want to press, but pressing increases pressure, increases stakes, increases emotional weight, changes how you react to normal price action, makes you do things you wouldn't do at normal size. At 1 unit size, you can tolerate a 20% pullback before your stop. At 3 unit size, that same pullback feels intolerable. You'll cut it early, you'll panic, you'll make emotional decisions. Not because the trade changed, because the size changed how you experience the trade. Position size should be inversely related to setup quality. The better the setup, the smaller your size. This sounds crazy, completely backward. Why would you size down on your best opportunities? Because your best opportunities have the highest failure cost. Everyone sees them. Everyone wants in. Everyone is trying to maximize. That crowding increases risk, even as it confirms your analysis. More competition means tighter edges, means faster reversals when things fail, means bigger losses when you're wrong. Small size on great setups protects you from the crowd, lets you participate without overcommitting, lets you add if you're right rather than hoping you're right with everything up front. Lets you survive being early or wrong without significant damage. Large size should be reserved for setups nobody sees. Marginal opportunities that emerge quietly. Structures that aren't obvious enough for crowds. Because that's where the real edge lives. Where you have timing flexibility, where you can be early and survive, where competition is minimal. But most traders do the opposite. Size up on obvious setups. Size down or skip the marginal ones. Then wonder why obvious opportunities underperform. I rebuilt my sizing framework around this principle. My A+ setups get my smallest size. My B and C setups get normal size. My weird marginal opportunities get my largest size. My results improved immediately. This also solves the confidence problem. You can be confident in an obvious setup without risking too much. You can participate without vulnerability. You can be right or wrong without it mattering significantly. The best trade isn't the one where you risk the most on the best setup. It's the one where you risk appropriately for the actual edge, where size matches uncertainty, where you're positioned to survive variance and capitalize on resolution. Most trading advice about position sizing focuses on percentages and formulas. Risk 2% per trade. Use the Kelly criterion, size based on account equity. All useful frameworks, but they miss the core insight, size based on edge clarity. The clearer your edge, the larger you can size. The more uncertain your edge, the smaller you should size. Your best setups feel like clear edges, but are often unclear edges hidden inside obvious patterns. That confusion costs money. Your best setups are expensive because they feel cheap. They feel like free money, like obvious opportunities, like things you should maximize and press and squeeze everything from. That feeling is the cost, the certainty, the confidence, the desire to optimize around things everyone can see. Real edge lives in uncertainty, in discomfort, in setups that don't feel perfect, in positions sized to survive being wrong, in timing that accepts imprecision, in patterns nobody taught you to trade. Your expensive setups taught you pattern recognition. Now you need to learn everything that makes patterns work or fail: the context, the timing, the size, the crowd dynamics, the regime dependencies, the 1,000 variables that determine whether your perfect setup makes you money or slowly drains your account. This is advanced trading, not more complex patterns, not more indicators, not faster execution, just seeing more, understanding more, thinking more clearly about why things work when they work and fail when they fail. Stop hunting your best setup. Start building systems that work, whether that setup appears or not. Start sizing appropriately for uncertainty. Start valuing timing as much as pattern. Start treating confidence as a warning rather than confirmation. The market pays for perception, not correctness, for seeing what others miss, not seeing what everyone notices, for being positioned properly when probability resolves, not for knowing what probability should be. Your best setup will show up again tomorrow, and the next day, and forever. The question is whether you'll trade it the same way you always have, or whether you'll trade it like someone who understands why that perfection is expensive. Make it count.